Robschild. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Today is September 7th, Saturday. This is for the Friday, September 6th. I said I wasn't going to do a show yesterday, and so I'm doing a show today for that day. 2024. In today's episode, I've got to give myself a little bit of kudos here. The market did crash, but just not as much as I predicted. The SPY 540 puts I mentioned that I had did print. It did go below 540 during the day. I was able to get out at actually as soon as it bottomed in the beginning of the crash in the morning. That's when the price was at its highest because there was still a good amount of time left on it while it was going at that direction. And you know, the Vega, the Omega, the Theta, all these things influence the price. I got out at a very good price with that. Just wanted to share some bragging rights on that real quick. Also, my UVXY calls, I was able to sell at a pretty nice profit. Again, this wasn't like 50% account, kind of move, which I was expecting. I was thinking it might happen that way because I was expecting a larger market crash here. The reason it wasn't as large as I expected was mostly because the unemployment rate came in as expected. The expected unemployment rate came out at 4.2%. That's what the market had already been predicting. And that's lower than the last reading of this at 4.3%. Now, this certainly looks nothing like a trend change. This is not like, oh, unemployment's going down now. No. The chart, if you look at it, it almost always goes up one month, down the other month. You know, your typical bullish chart for something going up is up like up 3 ticks, down 1 tick, up 3 ticks, down 1 tick. That's how these things typically play out. Unemployment to me is clearly headed higher, much higher. And so I'm still very confident that we are in this major slowdown, breakdown of the U.S. economy right now. So Robschild, if the unemployment report came out as expected, well, then why did the market sell off? Well, a little bit more data involving that. The actual employment report, the last reading of this was 89,000. Expected was 161,000. The actual was 142,000, quite a bit lower than the market expectation. I think there have been market participants that have been expecting it's been crashing from like a very, very good numbers, but looking like this. I think some people were expecting it to like flatten out here, and instead it's just continuing straight down. So my hypothesis, my thesis, my crystal ball reading suggesting that this is it. This was the top. It still holds for me. I'm very bearish. U.S. specifically the S&P 500 and the NASDAQ, which can bring everything down with it, along with oil. Gold, I think, will break here as well. But we'll go through a number of charts I want to share. I just wanted to also bring up one thing that I saw on Gareth Soloway's show from Verified Investing. One thing that he mentioned on his show was that he believes that the 10-year yield is going to bottom around 3.15%, and I am in disagreement with this. I think that it is going to drop lower than this. Part of it has to do with, if you look at yields around the world, Europe, China, Japan, their yields are all lower. For the US dollar to have this high of a yield is still like overly restrictive, and it's likely will end up going past what would be normal in this cycle. I really don't think we're making even necessarily a higher low in interest rates overall. I think we are actually headed into possibly negative rates. Am I going to be betting on negative rates? No. I like to buy things that I think are cheap and then sell them when I think they're like a normal price. That's kind of my method, my way of thinking overall with how to take advantage of what I consider to be the mispricing of securities and markets. But one important part to this that he mentioned on his show, I wanted to say that you need to be very much aware that yields beyond the Fed funds rate are controlled by the secondary market, not the Fed. So when you're looking at the 2-year note yield or the 20-year bond yield, this is not something that the government controls. This is something you and me control. This is something that the institutions control. The outside investors control this. This is not controlled. The only thing that the Federal Reserve controls is the very front end of the curve, the federal funds rate. Granted, the rest of the curve is affected by that because it will try to calculate where the Fed funds rate is going to be in the future, but they work together. It's not controlled by the Fed by itself. Interest rates don't actually need a Federal Reserve at all to discover how much how much interest should be charged. It's based on inflation expectations and supply and demand of borrowing money. Now, part of Gareth's idea that the 10-year yield will actually bottom at 3.15% is the belief that is widely held out there by a lot of people right now that as soon as we do 1, 2, 3, 4 cuts from the Fed to make monetary policy easier, so money is cheaper to borrow, that's suddenly going to make inflation explode higher. When the Fed, I'll repeat this, I said this on the last show, when the Fed was hiking rates, because of how much money the government was spending, it didn't matter how much they hiked it. We still had inflation just going up and up and up out of control. When you have a government that's spending enough money, it doesn't matter how much the Fed can raise its rates. It has a muted effect on its ability to calm down inflation. Now we're on the other side of the same coin. We are cutting, and those cuts are going to have a muted effect as well because of the fiscal dominant situation that we've just been in. I'll add to this that, when the Fed cuts by 25 basis points, we don't usually see the effect of that fully for as much as an entire year. So to expect cut, all of a sudden, inflation's just going to go to the moon again, no. It's not going to happen that way. In fact, I am stating right now, I think we're headed into a lot more disinflation and deflation. And the fear of the inflation from this previous cycle will add to the deflationary pressures, and I think we will have a legitimate depression coming up here. Again, no advice, and I'm just a guy with a crystal ball. Before we get onto the charts, daily reminders, 2-year, 10-year Treasury yield curve was inverted for over 2 years. It's now more clearly uninverted as of Friday. This has not happened since the 1920s, before the Great Depression. So when people are asking, well, why is Robschild saying there's going to be a depression? This is a big reason why. This is a huge, huge red flag why this is not something that you can just sweep under the rug and say, oh no, everything's fine. This is not fine. We are headed straight into some major chaos. I'll add to this, Somme rule triggered, saying recession has started. My crystal ball rating on everything. Market crash continues. I expect lots of volatility continuing out throughout this whole month. I don't even see a lot of bounces here in my crystal ball. And again, I don't think the Fed will, I'll read it here. The Fed will not cut fast enough to save the economy. And even if they do, the effects of those cuts are not going to be enough either. I think this is very bullish for bonds and not really anything else, specifically U.S. Treasury bonds. They are the most unloved. People are scared of them a little too much still. Best dry powder out there, in my own opinion. It's where I have 55% of my own portfolio. The first chart I want to bring up today is called the 10-year break-even inflation rate. This chart basically uses the smartest money out there, the Treasury bond market, the rates that the guaranteed rates on treasuries, and it predicts inflation. This is what the market believes inflation will be, the smartest money out there. It's called the 10-year break-even inflation rate. What it does is it determines the difference between the rates that you can get on a treasury inflation protected security, so the TIPS, versus a 10-year regular treasury that doesn't have inflation protection. In a nutshell, this number is what the market is currently predicting is inflation moving forward. And I need to point out here that we are not bottoming, we're not heading higher, we're heading lower. The last reading of this specific chart for Thursday, September 5th, is 2.03%. The last low of this was 2.04% on August 2nd, and it's obviously headed down here. And obviously after Friday's data, it's going to be heading lower. We haven't seen it this low since 2021, when everyone was still saying that inflation was transitory. Well, here's the inflation, and here's how it, and it was transitory. It was just a longer transitory period than other people thought. That's how I'm seeing this. I am expecting this to continue lower here. Now, just to show off a little bit, SPY, I said, my puts printed, and they sort of did. The bottom of the day was, only about 20 cents in the money. So if you were to exercise those contracts, they'd only be worth about $20 per contract. But the beauty of this was that, I saw the unemployment report come in honestly hotter than what I expected, and the market really cracked, and I was like, that much movement down, I'll get out right here. And that happened to be the highest price of the day for those contracts. So although I didn't, get a 50% return on my whole portfolio, I still made a handsome profit here. But, enough bragging. That's the hog side of me. They say, pigs get fat, hogs get slaughtered. Well, luckily, I didn't hold on to it till the end of the day. But anyway, it doesn't matter. Enough about that. Let's get on to the charts. So it was a large red candle, as was seen in my crystal ball, as I had predicted. We are still very clearly in this head and shoulders top formation. Looks, it's headed. The directionality and the momentum that it has to the downside is extreme, and I don't see what's stopping this now. Next week, I think markets will be really crashing. And then looking at the pattern, when we get down to this line, if we get below it, from a psychological standpoint, me and every other person that watches charts in the whole world sees this head and shoulders top here. This is going to drive the market much, much lower. This is crash imminent. This is crash happening. I think this is it. I don't think we have a viable dip here. When you add everything up together, anybody that's in this game understands the problem with the S&P 500 being at a PE ratio around 30. There's a thing called climbing the wall of worry. This is an effect that markets can have where they go up way higher than they should, but part of the reason they keep climbing is because there's too many bears. So you climb to kill all the bears. In other words, people bet on, it's overvalued, it's going to go down. And they keep doing that. And so the market actually, it causes maximum pain to people trying to trade the market. And so when you have a wall of worry climbing up, that's how you can get to a 30 PE ratio in the S&P 500 in the first place, is we're clawing our way up and killing all the bears. The bears are dead, apparently, I think. I think the bears have all died, and now there's enough fear that no one's going to be able to save this market here. To add a lot of fuel to the fire, something Gareth Soloway talks about is a lot of the speculation in markets that a lot of participants have been hoping on has been the semiconductor industry. And report after report, these companies are coming out with weaker than expected earnings, as I have been expecting fully to happen. I didn't know when it was going to happen, but Friday there it was Thursday, I think, after hours. One of the big makers came out with really bad news. And when one maker comes out with bad news, it affects all the semiconductors, because people realize, oh, they're not making infinite amounts of money forever into the future. Just like the railroads in 1929 before the Great Depression. You really don't need to have a crystal ball to see this. So with speculation starting to burst here, yeah, this is it, folks. I strongly believe. And one more thing to add to this is the September effect, and everybody knows about it. September, October, typically not great investment months. It's all so much fuel to the fire here. And then, on top of it all, when you have situations like this, all of a sudden you have banks blowing up all over the place. You have things that unexpected, like the yen carry trade blowing up. If you think that was the last canister, that was the first one. We're headed into more. The fire's burning. There's canisters that look like they're going to explode. We don't know which one's going to explode yet, but it's going to be a heck of a time. I have a lot of charts lined up that I want to just go through. This is SMH, the semiconductors ETF themselves. Obviously, big crack to the downside for Friday, very securely in this head and shoulders top. The real confirmation will be breaking this neckline. Specifically in this chart will be a pretty big, that's it, game over kind of scenario. And it looks like it's very obviously going there at this point. The NASDAQ QQQ doing the same exact thing. Huge bearish candle on Friday's trading day. Head and shoulders top. VIX futures term structure completely inverted here. The front end is supposed to be cheaper than the long end, and for the next 2 months this is highly inverted to the entire rest of the curve, suggesting that the volatility is expected here. The crash will continue. I refer to Friday as being a crash in markets, partly not because of the amount that it went down, but also because of the breadth of the bearishness. Pretty much everything got sold off. It wasn't like some markets, fell and some markets did okay. No, everyone sold everything off on Friday. This is what a crash looks like. So just to go through some charts. Again, this is not a huge looking red candle, but the point is that it is a big red candle. This is copper miners. Crude oil still continuing down after cracking a major trend line here. Gas should be getting cheaper, by the way, is the good part of the news here. Silver, engulfing candle to the downside. If you're hedging with silver and thought that silver would survive here, well, remember it's half an industrial metal. REMX, this is my favorite metals ETF because it's if you look at its history, it's dropped by like 75% or something since 2011. Highly undervalued, I think. These companies make strategic rare earth metals. They're generally associated with platinum, palladium. This cracked today. I thought maybe we had a bottom here, but so this is looking like I'll be buying this actually as it continues to fall. Maybe at some trend line I find around 30, below 30, maybe even. Uranium, I was very bullish on uranium for a while until I thought it got a little expensive. I sold out at a perfect time, and this market is also starting to crack. Brazilian equities did not hold up either. This is an engulfing candle. If you've been watching the show, you know that this is one of my favorite areas of stocks that I think is undervalued compared to the rest of the markets. But this also did not get saved at all. Important side note, Graham does say this, when markets generally are overvalued, things that are undervalued can become more undervalued. And so, that's why it's important just to realize that can and will happen. even if you have something that's like very, very obviously undervalued, the market doesn't care when the whole market's moving down. Things can change, things can get more complicated later, but a day like today, everything sold off. Bitcoin looking more bearish than it's looked in a while. Currently on Saturday, we're at 54,000 around there. The longer term view of this here is like, it looks like a bull flag from the beginning of 2024, right? Pretty clearly. So the more probable scenarios for it to break out to the upside from looking at a chart, just a chart standpoint. But I'm not touching this with a 40-foot pole, considering where we are in the cycle. This is risk off mode for me. This is not a time to start getting speculative. I suggest the absolute opposite. Again, no advice. ARC F, Kathy Wood's fund, big red candle today engulfing ARC K, big red engulfing candle. One of the more odd parts of the market is still high yield corporate. They're still not detecting as much fear as I think there should be right now. But it's looking frothy here. When you have moves this large going down and back up, I see this as a bounce. I fully expect this to continue down here. I own longer dated puts on HYG right now. I think puts on HYG are they line up with my viewpoint that markets are a lot more bearish than other market participants believe right now, and I think that's going to be changing in my favor massively this coming week, and the following weeks. TLT had a very wild day on Friday, and now you can, depending on your screen, you can barely see it. This, where my mouse is right now, it is actually the candle. If you look closely enough, there's a wick that goes all the way up to $100.80 and as low as $99.20. It opened and closed exactly at the same point. So this is a huge fight right here. It has to do with a previous trend line. So people that had bought TLT or Treasury securities in this big dip thing, a lot of them are getting out, and there's other participants that are getting in right now because they see the economy slowing here. So there's a big battle right now in the Treasury bond market. Very exciting to see. I fully expect this to break out to the upside, obviously. Otherwise, why would I have 55% of my portfolio in TLT, ZROZ, and TMF? The fear of inflation, it's so prevalent out there. Everyone's like, oh, we just had really high inflation, therefore we're going to keep having more high inflation. I don't think so. One thing that helps me with that idea is the value of the dollar. I think we may have bottomed in the dollar, actually, at 156 cents or whatever. I see a pattern of higher high. I think this was a higher low here. I think this will be trending up, despite the fact that we have cuts coming. Normally, when the Federal Reserve is cutting and making monetary policy easier, it would create weakness in the dollar. But if things are falling apart faster than what the Fed should be doing, then the dollar can actually go up from here. I think I saw in a headline, this is the S&P 500. I think I saw the headline saying something like this was the biggest down week of the entire year of 2024 so far, and it certainly looks like it. This is a weekly bar chart looking a big giant red candle like this is very formidable. I talked about this chart before too, with this previous week being like a hammer. Here looking like a very obvious reversal pattern, and it's playing out like clockwork. Again, the head and shoulders top here, clockwork, folks. Sorry for the disorganization of charts a little bit. The 30-year Treasury yield, though, the upside down of TLT, showing a lot of weakness here. Obviously, looking like it's going to keep going down here, giving weight to the idea that TLT may be a good place to be. Last chart that's important to bring up is the CME FedWatch tool that tracks the probability of cuts that the Federal Reserve will make. Notably, during the day, Gareth Soloway pointed out that, I think it was during the day, I saw the show later, he pointed out that we flipped to a double cut for September, I thought, but now it looks like we're at a single cut for the September meeting, and then a double cut for the November meeting, and a double cut for the December meeting. So aggressive cutting incoming quickly. So the market did get spooked here. Honestly, I thought it would be spooked more. I thought the unemployment rate would just shoot higher, but not everything can go in a straight exact line the way that I predict and see in my crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.